The nationwide risk managed income ETF, let's just call it NUSI. Is the 8% dividend yield worth the investment? How does it compare to QYLD? Is the monthly payout dividend safe? And how the heck do taxes work on this fund? We're discussing that and more in today's video. Now, this ETF, ticker symbol NUSI, is, as I mentioned earlier, the nationwide risk managed income ETF. But I'm going to put an emphasis on nationwide. Oh yes, this is the same company with that catchy TV jingle. Come on, sing it with me. Nationwide is on your side. I didn't hear you singing. So in this video, we need to talk about what this fund actually does, the monthly income it provides to its investors, and what you need to know about taxes and what first steps to take when you decide to invest in NUSI. So before we get started, I ask only just one thing. Hey, don't be dumb. Tap the thumb on this video and let's get started. Now, NUSI is very similar to QYLD in the fact that it participates in the covered call option strategy. NUSI is an actively managed ETF, and they have holdings in the NASDAQ 100 index. Now remember, this index is focused on tech-heavy stocks and large companies, as you see here. The difference with NUSI compared to QYLD is that they have a rules-based options trading strategy that is called the Protective Net Credit Collar, aimed to provide high income with reduced risk. If that just sounded like a bunch of random words, don't worry. I'm going to explain it all in this video. Now, if we look over the history of NUSI, we're going to see a dividend payout. It's a pretty good amount, anywhere from 7 to 7.5% on average, to a high of about 8.10% in June 2021 to its current 7.45%. Not a bad dividend yield for an options type of ETF. In fact, some would say that's great. Now, that's not as good as the 12% that we often see on QYLD, but you got to remember that NUSI offers that downside protection. And what that actually means is we want to make sure that we're getting our income, but at the same time, we're not adverse to potential fallback. Let's say the market goes on a bear run. All of a sudden, it's starting to slip back down. There's a big market correction. NUSI, their goal is to limit that amount of risk so you're not crying all the way down, whereas QYLD, there could be a little bit of that risk. And speaking of which, the key difference between NUSI and QYLD, NUSI not only provides that covered call option, but it does a protective put. Now, NUSI could be something to consider investing in if you're interested in, number one, a monthly paying income ETF. Number two, a bond alternative that can give you greater flexibility across different market cycles. And number three, supplement your overall dividend paying portfolio if you are a dividend investor. So how does this actually all work with NUSI? Number one, the first thing they do is they purchase positions of companies represented in the NASDAQ 100 index. So they have those holdings, and then the second thing that NUSI does is that they purchase covered call options against the NASDAQ 100 index. So the fund managers will sell covered NASDAQ 100 call options whose strike price is above the current trading price of the index. Now, I'll explain this very briefly in just a moment. And number three, and this is what makes this one different from QYLD, is that the managers will then purchase a NASDAQ 100 index put option to fully hedge the portfolio. Now, the net credit, which is the difference between the proceed from the sale of the covered call and the cost of the puts, is then returned to the investors as monthly income. I do think it's worth noting that this is actually called distributions, not necessarily dividends. We refer to it, I've been saying it in the video, dividends and dividend yield. But when we talk about things like NUSI, when we talk about things like QYLD, these are technically distributions as a result of these options trading activities within the ETF. A dividend typically, whether it's from an ETF or from a company, is specifically those profits that are paid out in the form of a dividend. Because this is more of an options trading strategy, I guess you could argue that maybe it's profits related to the activity of the fund, but really it's a distribution. So I've done a video before explaining exactly what a covered call is. You can check that video out after this one if you want to learn a little bit more about that. But in NUSI's case, I've never talked about what a protective put is when it comes down to options. So let's talk about that so you can kind of understand both spectrums of what this fund is aiming to achieve. So let's make it make sense, just like we did last time, and I'm going to pull up my Robinhood portfolio in just a moment, and we're going to simulate a protective put on our favorite company, Apple, just to kind of show you exactly how this would work as if you and I as individuals are buying options in the options market. So the very first thing, I'm going to select September 3rd just as an example, and then I'm going to click it right where it's at. You can see it says buy put. Now, in this case, what we want to do, of course, you need to have at least 100 shares of whatever stock you're looking to trade this option on. So let's pretend we have 100 shares of Apple. In Robinhood, what I'm going to do is I'm going to look at where my share price is. You can see right here, it's currently at $147.80. Now, what I want to do is I actually don't want to go up like I would in a covered call. I would actually want to go down. The reason you want to do this is you're protecting yourself from a downfall. Let's say all of a sudden Apple decides to take a poop. Well, you don't want to poop with it. What am I talking about? You want to make sure that you're not going to keep losing money. So here's how I'm going to make this as easy as I can. 147.72 is the share price of Apple. Let's say we're like, hey, if it drops to 140 a share, I don't want to lose any more money as it continues to take a poop going down the slide, okay? So let's say, for example, you're okay if it drops from 147 down to 140, but man, if it goes to 135, 130, 120, 110, you're crying. And you don't want to sit there and manage it. You want to just trade the option. You just want to say, let me do this, let's make it easy. I'm going to do this protective put. So I'm going to say 140 is my put. And I'm going to hit buy, and then I'm going to reserve the right to sell my 100 shares on or before September 3rd, and I'm going to have to pay $70 as a premium for that protection. So if all of a sudden something weird comes out and it makes that stock price go down in the next couple of days, I can then sell my shares at only 140 if I decide to exercise this protective put option. Why would I want to do that? Again, it's to not go down the hole with Apple. If they drop to 135, 130, 120, I still have the option to then sell my 100 shares at $140 by September 3rd. Now, if it's after September 3rd in this example, guess what happens? The option expires and I'm kind of screwed unless I buy another protective put. So that, in its most basic form, is how this side of the options trading strategy works. Next, let's talk a little bit about the difference between NUSI and my previous video on QYLD. Very similar, but there's a little bit of difference too that you need to know about. And I also want to touch at the end on taxes, very, very important. So let's put them head to head. First of all, NUSI, NUSI, whatever you want to call it, holds an expense ratio of 0.68%. That means for every $10,000 you invest into NUSI, you're going to be paying about $68 in expense fees. That is a little bit different than QYLD. QYLD is only at 0.60%. Now, this is technically a higher expense ratio because it's not a passively managed fund. What that means is this is actively managed. And anytime you have an actively managed ETF, typically those expense ratios are a little bit higher. So that is kind of obvious because a manager has to go in every single month, buy covered calls in the options market, buy a protective put in the options market, and play that game month over month. So there's actually somebody actively managing this fund and thereby giving you distributions every single month in the form of those payouts that we just talked about. As to be expected, another difference is the return history. If we look at the 1-year return comparison of NUSI to QYLD, it's 12.25% for NUSI and 17.12% for QYLD. Don't expect to the moon type of returns. This is not a growth stock. This is not a growth ETF even, like a QQQ. Now QQQ, they invest in the NASDAQ 100 index just like QYLD and NUSI, but remember the big difference here. QYLD and NUSI, they're all about income producing assets. Like the goal here is to get income every single month. QQQ is all about that growth. Sure, you're going to get some dividends from time to time, but over the long term, you want to see some exponential growth. That's the big difference between when we talk about NASDAQ 100 index funds and the difference between these ETFs. So a lot of people say that, hey, I like NUSI because I like to just park cash in this fund. This is a very safe, risk-averse fund. I like to just throw some extra money I have sitting around into this and gain some distributions every single month. So they can leave it in there for a year or two, collect some money. But that brings us to an important topic, tax. Uncle Sam, the stupid taxes, we got to talk about them because this one's a little bit weird. Now, to do this, to really look at what we need to understand, we need to go over to the NUSI site. And what I'll do is I'll link this particular site in the description of this video so you can check this out for yourself as well. What we want to then do is scroll down on the website to where it says supplemental tax information. Within this arena, we then want to choose a monthly statement. Now remember, these are not tax documents, but they can help us understand how we're tracking. So we're going to click on this. We're going to click on July 2021. That's the latest form that I see on here. We're going to use that as our example. So let's see what happened here. Since we're in a bull market right now, as of summer 2021, we got a lot of things going on. The options trading for covered calls likely won't generate a whole lot of income as we'd normally expect. Now, the idea, when you talk about QYLD or NUSI, and you got this covered call strategy, the goal is to have it kind of sit around there, but not actually go up. If it goes up, that's where those buyers can then exercise their options. Basically, what that means for NUSI and for QYLD is that they kind of have to deal with that, and they got to pay out that money. Well, in a flat market, in a boring market, this is where you can collect some serious premiums. And that's the beauty of all of this. Remember, just check out that covered call video if you're still not sure with how this works. I think that'll help you understand this a little bit more. But that's a great way to make a lot of money. But in 2021, or at least now up until the summer, we've been seeing a nice little bull run. So it makes these options a little bit stale and boring. But they still want to pay you monthly distributions. That's kind of their goal. They want to say, hey, for example, in July 2021, we're going to pay you 18 cents per share. Well, how do we keep up with that? We do something a little bit different. And that is called return of capital, as you can see right here. So in this particular month, the return of capital is essentially your invested money returned to you. This means your average cost per share that you initially invested in ultimately goes down against the net asset value of NUSI. Now, what's interesting is in this case, the return of capital that you're going to get on those awesome dividends that you get paid every single month ends up not being taxed the same way normal qualified or non-qualified dividends get taxed. Here's how it works. Unlike taxable income and capital gains, return of capital is not taxed in the year in which it's received. Now, this is because it would neither be classified as income nor profits from the investment. Instead, if you really think about this, the return of capital distribution just reduces you as the investor your adjusted cost basis. This means you have an increased amount of capital gains that's realized when you decide to sell your shares. So really, you're just getting return of capital, and if you reinvest it, that's cool, but if you don't, oh well. The point is you're getting like a refund, a rebate, I guess, if it is in the form of return of capital. So that's why it's important to always hop over to the website, check out their monthly statements and see, how am I getting paid this month? Is this actually options premiums? If it's options premiums, going to be a little bit of a different tax story, and I'll probably be taxed as normal. But if it's return of capital, which is happening quite an awful bit in 2021 with this bull market, and if it continues on, it'll continue to happen quite a bit, then I'm not taxed until I hit sell on NUSI. That's a key point. But you got to keep in mind, if you got tens of thousands of dollars invested and you had it for a long period of time, you will be hit with a rather large tax bill once you go to sell. Now, of course, this is all related to a taxable brokerage account. If you have your investment in NUSI in, let's say, a Roth IRA or some type of other tax-shielded retirement or investment account, it may work a little bit differently. Now, as I said, I'm not a tax guy. I'm just some YouTuber talking to you right now that sometimes looks a little bit like Woody from Toy Story. So I recommend pinging your favorite CPA to verify what works best for you based on your financial situation. Do you like NUSI? Have you invested in it? And what do you think about it? Comment below, let's have a chat. But until next time, here's another personal finance video that can help you with your journey. Here's a video YouTube thinks you're gonna like, and until next time, we'll see you on the next video.